Let's go ahead and get started. Good morning, everyone. I'd like to formally welcome you to the first webinar that we're running since I've taken over as the CEO of MIOD. So I'm particularly delighted and thank all of you for joining. Before I introduce the speaker and the topic, I just want to tell you a little bit about MIOD and also how this webinar will run. အားလုံးပဲမင်္ဂလာပါရှင်ဒီ webinar ကတော့ English language webinar ပါဒါပေမဲ့တကယ်လို့သာမေးစရာရှိလို့ရှင်မြန်မာလိုမေးလို့ပို့ပြီးအားရတယ်ဆိုလို့ရှင်ကျမတို့ chat box ထဲမှာမြန်မာလိုမေးလို့ရပါတယ်နောက်ပိုင်းလဲကျမတို့ကိုဆက်သွယ်ပြီးတော့မြန်မာလိုရှင်းပြပါဆိုလို့ရှင်လဲကျမတို့ special session လေးလုပ်ပေးနိုင်ပါတယ်ရှင် So just explaining to the Myanmar language speakers that the webinar today will be run in English, but questions can be asked in either language in our chat box. And later on, if it's enough demand, we can also run a session just to explain a bit of what happened in this webinar in the Myanmar language. So my name is Rita Mon, and I am the CEO of the Myanmar Institute of Directors. And I'm delighted to be taking this position. I just joined very recently, back in July. And although I have been involved in the corporate governance initiatives in the country, especially led by the IFC since the country opened up and our governance landscape and the corporate landscape changed. So with the support of the IFC, I had the opportunity to attend the Institute of Directors training in Thailand and got an appreciation for what it means to be a board director. I sit on quite a number of boards, but without the formal training until I went to the directorship training program and really quite appreciated that. So my background has been in investment banking. I had an MBA. So I initially had the idea that I knew what it takes to be a board director, but the director training completely changed that thinking for me. So when the Institute of Directors was established in our country, in Myanmar, I really wanted to give support and initially signed up as a potential trainer. And now I am a part-time CEO and I'm completely delighted to take that role. One of the reasons why I was interested was because I'm an investor and I'm also somebody that helps investors invest in this country. And I really believe that our country needs good investment capital, not just any kind of capital, but good capital, and good capital that comes with practices that will help the companies in our country grow. And that is a good segue into why we're having this webinar today, which is to look at corporate governance from an investor's perspective. And when we think of corporate governance, I'm very much aware that some people may see it as a bit of a tick box exercise. And I took this role with MIOD because I firmly believe that corporate governance is good for companies. It's good for companies to understand how to govern properly, have the roles and responsibilities between board and management, and have systems set up where we can evaluate performance, set strategy, and know the path ahead. And that it is actually first and foremost an aid for companies to be sustainable, thrive, and grow. Now, I'm delighted that the IFC is supporting us on this initiative. The IFC's corporate governance initiatives and the models that has been developed as an investor in the private sector has been copied world over, and it is really setting the standard. And we benefit in the Myanmar Institute of Directors to have all the learnings that the IFC has from around the world. The IFC has been a pioneering investor in Myanmar. It's got probably the largest investment portfolio in the country. And one of the roles of the IFC is to pave the way for outside investors to come in. Can we have someone has their microphone on? Microphone leပိတ်လို့ရမလားမသိဘူးရှင့်ကျေးဇူးပါ And I've been involved in some of the IFC's earlier investments and know the rigor that the investment process brings, but also the benefit that it brings. And I've seen the companies that IFC has invested in the early days thrive and really set themselves up for success going forward. So today, our speaker is Chris Razuk. He leads the CG initiative for the region for the IFC and has many years of experience, including in Myanmar, where he's been involved in some of the investment activities as well as corporate governance promotion activities. Chris, good morning.
Good morning, Gary. Good morning, everyone. I was going to say nice to see you all, but I only see about a dozen of you. So, but I know that you're out there, so I'm glad you all could join.
Some people are shy, hiding behind the camera.
That's fine. That's fine. At least we have great turnout. We have up to almost 80 people so far. So, very happy to see the turnout, and very happy that you could make time to be part of this webinar. So maybe. Go ahead.
Yes, everyone. So Chris has a presentation that he will be taking you through. I will be monitoring the chat box to see if there are questions coming, and we will try to make this interactive so that you can ask questions along the way. We will have time for questions later on as well. This webinar is scheduled to run until 11:50. So we think the bulk of the presentation will be in about an hour or so, depending on how many questions we take along the way. Let's keep this interactive so that we can address some of the initial questions and the foundational ideas as we go on. As I mentioned earlier, to those of you who are just joining, you can ask questions in either language in the chat box, and I will get that across to Chris. And we really look forward to having a very productive discussion. Chris, over to you.
Okay, thanks again, Terry, and hello again, everyone. I hope you're all keeping safe and healthy. I'm in Hong Kong, which, as you've probably seen in the press, we were doing very well for a couple months, and then we kind of took some steps backwards regarding the COVID virus. So we're a bit more closed down now, but I am in our office. It's a pretty empty office. Most people are still working from home. Again, happy to be part of this webinar. Let me just share my content so you all can see it. A second. Okay, I trust you all can see that. Terry, let me know if you cannot, but hopefully that's okay.
We can see it, Chris. Thank you.
Okay, very good. All right, so I'm very happy to be here, and I think, really the purpose of this was to, it's a short session. We have about an hour plus 30 minutes Q&A as we need. We want to just use that short time to take you inside the mind of an investor to the extent we can, and in terms of how investors look at corporate governance from our own experience, of course. So I want to talk about how, when we're investing in companies, and we've invested quite a bit in Myanmar, how do we look at governance? What are some of the things that we look at? What are some of the common challenges that we see, particularly in the sort of companies that we find in Myanmar, which are, tend to be private, closely held companies? What are some of the common challenges that we come across? And then sort of what are our expectations as an investor with regard to the sort of governance practices that we like to see in place? So that's what I like to try to cover. As part of that, I'm going to give you lots of examples. I don't want to make this a theoretical exercise. So I'm going to try to give you lots of real examples. This is what I do on a daily basis. My main job is to cover corporate governance work in our investment activity. And I've Latin America, Middle East, North Africa. I've been covering East Asia for the past 7.5 years, and that includes a lot in Myanmar. So I have a lot of experience working in Myanmar. And I also mentioned up front, Terry had alluded to this, but I've had the great pleasure of working in Myanmar extensively for the past 6 to 7 years. It's a country I love dearly, and I've been happy to see the progress that's been made in Myanmar with regard to corporate governance. There's still a lot of work to be done, certainly, but there has a lot of progress made. And this is crucial because I think Myanmar, as it continues to open up, companies in Myanmar want to grow and expand. They need to attract investors. They need to bring in capital or business partners. It may not even be about investment, just attracting other business partners. These investors and partners will have expectations, just like we do with regards to governance. And also, as you become more integrated into the ASEAN community and the wider regional community, the standards need to be raised in line with other ASEAN markets at a minimum, and we work across those. I'm very familiar with work in those markets as well. So it's important to sort of keep up with your peers as you continue to open up. So this is something that's important, not just for us as an investor, not just for you as a company, but for the market and for the economy as a whole. So what I'll do is there's sort of three parts. I'll just talk generally about our methodology, why this is important. I'll just spend a brief moment on that. Then I'll get into a couple key areas that I think are important to dive into. One is shareholder rights, right? So again, I'll speak from our experience. When minority investors come in, shareholders come into a company, what are they going to expect? What are the things that they're going to look for? And therefore, you as companies, what can you expect in terms of that experience? And then I want to talk about the board of directors, of course, at the heart of good governance, and just give you some experiences and insights that we've come across. As Terry said, I've got about an hour max presentation, but do come in with questions anytime in the chat box. I'll pause a few times to see if there's any questions on what I've covered, but the more interactive, I think the better this will be. Okay, so first of all, just talking about our methodology, again, Terry had alluded to this, but IFC has really long been committed to sustainable investment for a long, long time. So, we have a set methodology both for our environment and social practices, our performance standards that a lot of you may be familiar with, especially our IFC clients that might be on the line. And then we have the corporate governance methodology as well. I'm going to focus on the corporate governance side. That's my area of expertise. I'm not an environment and social person, but I would say that one of the things that we've tried to do the past several years in particular in IFC is to bring these together to more closely couple them, right, in line with ESG trends you see globally. So we did even revise our methodology, our corporate governance methodology, to more explicitly cover areas of the governance of E&S as part of the broader corporate governance methodology. And this is something that we do in every investment. We look at environment and social practices. We look at corporate governance practices in every investment we do. And then we'll work with our investee companies to make changes as needed over time at the point of investment, but also during portfolio. IFC, for those that may not be familiar, we're part of the World Bank Group. We are an investment firm. We're commercially oriented like any other private investor, but of course we also try to be a sustainable investor, as I said, a responsible investor. But we are a long-term investor. If we invest equity, we're holding for 5, 6, 7 years. We're not a short-term investor typically, which gives us time to sort of work with companies as best we can in some of these different areas. And then from that work, from our investment-specific work, we're first and foremost an investment firm, but then we've drawn lessons from that to try to benefit the market in general. And so we have these broader advisory programs to help promote good governance across the market. And so we have an active program in Myanmar, as Thierry alluded to. And you can go to our website, ifc.org/sustainability, and you can pull down a lot of publications about governance and ESG more generally from that website. There's really a wealth of material out there. I encourage you all to take a look, including the methodology, which I'm going to kind of go through today. So just a word about, globally, you talk about good governance and ESG sustainability more generally. I'm sure many of you have already seen this. There's been a big push for this the past several years in particular. It's been a trend that's been growing, but I think in the past probably 3 years, it's been really taken off exponentially. So you can see that, this was a survey done in 2018, already a couple of years old by Morgan Stanley, but 22.8 trillion invested sustainably globally. That's about 1 in every $4 under professional management. So institutional investors, large institutional investors, are paying way, way more attention to this, to sustainable sort of investment. And of course, this is music to our ears because this is something we've been doing for a long time. And they're doing it, if you see the chart, why are they doing it? First of all, you see a large percentage, more than 80% are paying attention to ESG issues as their investment thesis. But they're doing it because it's material to performance, as they said. About half of them said that. So it's not a nice thing to do. It's not just because it's a nice thing to do. There's a solid business case behind this, and you can look at a lot of different indices out there. There's ESG indices for publicly traded companies, and they routinely outperform the market average, right? So the business case, I think, is clear. There's lots of documentation out there that reinforces it, but it's quite clear at this point. So for IFC, our own evidence, we looked at our own portfolio. We did a study, and you can go to our website and download this study. It's pretty interesting. We looked at our own portfolio over a couple-year period, and we looked at companies that had made governance changes and others that didn't make many governance changes over time. And we ranked them according to sort of a scorecard methodology. Bottom line is, if you compare the top quartile companies that scored better on governance versus the bottom quartile, the bottom 25%, the return on equity was almost 3 times higher, the top versus the bottom. Almost 3 times higher return on equity. I mean, that's astounding. That was much higher than we actually thought it would be. We knew there'd be a case, but that was actually an eye-opener even for us, that it was that high. Beyond return on equity, there's other factors. There's the credit risk rating was better for companies with better governance. You had development impact, which for us as a development institution, an investor but a development institution, the development impact indicators were stronger for companies with good governance, and the environment and social practices were better as well for companies that were better governed. So you can see the correlation in different ways with the benefits of good governance. This is why we pay so much attention to it. It helps us as an investor and helps bring other capital into markets and help companies grow and be sustainable. Just quickly, we have a big network of private equity partners globally. We invest in private equity firms globally. We're one of the biggest in developing in emerging markets, biggest networks. We heard from them to say, how has governance improved your performance in different ways? And you can see this here: improved valuation, attracting premiums over the market price, in one case, improved performance, access to finance, risk management, cost control. So it's not just us. We're hearing from other private equity and other investors that they're having the same sort of experience. Okay, so let me get into sort of what do we look at when we're looking at corporate governance? How do we approach it? Because governance, you ask people, how's the corporate governance in your company? You get different answers. It can be a bit of a nebulous term for people. A lot of people think, well, I think about their board of directors, first of all, and do I have independent directors on the board, and that's a sign of good governance? It's way more than that. Governance covers a lot of different dimensions, as you can see here. This is how we approach it. This is how we break down a company's governance system when we are looking at investments. It's these different dimensions. Commitment to corporate governance, first of all, it's sort of the intangible about the sponsors and the board. Are they committed to good governance practices, or is it just sort of a check the box exercise in order to get our money? It's hard to determine that sometimes, but you can get a feel for really how committed are the sponsors in terms of good governance. I think in Myanmar, we've had really good experiences in general. We've had a lot of sponsors we worked with that really are truly want to make governance changes because they realize the benefit of doing so. Board effectiveness, we'll spend more time on that in a bit, but that's really looking at how the board functions. So we'll get into that more in just a moment. But we go below the board level. We look at the control environment as well, right? So the day-to-day management practices, how is the company controlled? Internal control, risk management, internal audit, financial reporting. To me, that's just as important, if not more important than any other dimension. That's how the company is controlled on a daily basis. If we are giving our money to a company, we want to make sure they're going to have good controls in place on how our money is being utilized. We have countless examples of company where fraud has existed in companies. You have Wirecard, for example, in Germany, the fintech darling for so long. a lot of investors poured money into that company, and then just recently there's been a fraud in terms of accounting, the control environment. There's lots of examples like that. So we pay a lot of attention into the control environment. Shareholder and stakeholder practices. We're going to talk about the shareholder practices in a moment. Stakeholder practices is something that we are paying a lot more attention to. We've incorporated formally into our methodology. It's how does the organization actually treat its stakeholders? How do they hear about stakeholder concerns? How do they govern the relationships with stakeholders? That's an important emerging part of the governance and ESG landscape in particular. We look at the disclosure transparency practices, of interest, conduct policies, those kind of things. And then family governance. For family firms, there's a lot of family firms obviously in Myanmar. The role of the family in the business and how that can be governed, or how it might need to be governed more effectively for longer term sustainability. So just to give you a feel, again, putting you inside the mind of an investor, we're looking at a company. We do a full due diligence. There's a whole team that looks at the company top to bottom, and a big part of that is governance, right? And we will go and spend up to a week with the company. We'll interview lots of different people. I like to interview board members separately, maybe not every board member, but a majority of them if we can, along with different key management personnel. And we dive into these different areas and talk about their governance practices. And see if there are any areas for improvement. And then from that feeds into our investment process. I'll give you some examples of this in just a little bit, but we will incorporate that, quite often into action plans that we want the company to work on over time. And I'll show you in just a minute an example of that. Here's an example right here. So this is a sample roadmap from some client. Where you can just see, this is not even the full thing, this is just half of it. But you can see the different dimensions, like I just talked about: commitment to corporate governance, board level, control environment. We'll identify different things that we think need to be improved, what the priority is, and what the time frame is to implement those changes. And I want to emphasize that because governance is a journey, as they say, and it's true. I mean, you can't overnight make a lot of these changes. It's going to take time, and it's a continuous process. So we're very sensible and practical about how changes are made, but we do want to see commitment to making certain changes over time. So we'll identify a roadmap, and then we will quite often formally incorporate these into our investment agreements. So this is just a sample where if you look at the bottom part, the table at the bottom, this will be in the actual legal agreement, where we say we want you to commit to making changes 1, 2, 3, 4, etc. Here's the time frame. So we'll, maybe from the first disbursement, we will give them time to have this change in place. Again, we try to be reasonable about it, but we'll turn these into legal commitments if we think it's necessary. We do that all the time. There's also a sample corporate governance section at the top in the agreements, which will also specify, whenever needed, things like how we want the board to be set up, or certain committees. And I'll show you more of this in just a moment. But just to show that this is, for us, this is a very real topic. It's not, again, we don't do it just because it's a nice thing to do. It's an active, integral part of our investment thesis into organizations. Here's another example. I won't go through this in detail, but just these are real excerpts from shareholder agreements I'm showing you. I've taken out the name of the companies, of course. So yeah, we get them to commit from different time frames. Maybe it depends on the nature of the investment. I mean, if it's equity, it's one thing. Maybe if it's a convertible, like it's debt but then converted into equity. The time frames and the nature of the recommendations will vary, but that gives you an idea of how we approach this. Let me just talk about Myanmar specifically. Some of the common challenges that we see there. Again, I've spent a lot of time there, both working with companies specifically, investment companies, and at the market level, working on regulatory related issues, and this institute as well. first of all, I would say that most companies in Myanmar are controlled companies. You could say that about the region generally, but it's certainly true in Myanmar. The stock market's new, it's a tiny market, it's going to grow, but it's still very nascent stages. So most companies are private companies, a lot of family-owned companies, as you all know, or state-owned companies, which means that there's almost always going to be a controlling shareholder, right? One shareholder, one sponsor that has control of the company, even if there's other investors involved. And that presents different types of governance challenges than, say, if you look at a lot of the governance challenges you see maybe in in New York listed companies, big listed companies in New York or London, where you've got tens of thousands of shareholders, none of which have more than 5%, that's a different types of governance challenge, right? There you have the agent issue, and you're trying to, in those cases, you see a lot of the governance challenges that come from those types of companies in the West. They're trying to safeguard against powerful CEOs who might also be chairmen or chairwomen, combined CEO chairperson roles that become really powerful, and the shareholders don't have much power because they're so dispersed. It's a different sort of context for Myanmar, which is here you have a powerful sponsor, controls the company, who you're trying to just make sure if you're coming in as a minority investor, how can we make sure we have an adequate voice on decisions and how the company is run? So that's the fundamental governance challenge that we almost always have to deal with. And whether that's a family-controlled company, again, or a state-controlled company, where the state is the main sponsor, you have these kind of challenges that we have to address. Family companies, a lot in Myanmar, they're the backbone of any of the economy there, which are great. There's so many great companies that we've seen. They have unique challenges because of the role the family plays in the company, which is a benefit. But then as you start to grow and bring in other investors, there are certain transformational challenges that we often have to deal with. The presence of state ownership in a lot of companies, of course, and that's to do with, how do you sort of depoliticize some of these institutions, make them set up more in corporate form, more commercially oriented. That's a big challenge. I do this quite often in our investments globally and in Asia in particular. The challenge of finding independent directors, I think in Myanmar, this is something that's getting better, but it's an issue that's been there for a while. And frankly, that was part of the genesis of setting up the Institute, was to start to build a pipeline of certified directors and do other things about promoting governance in the market. But I think finding independent directors, the right directors that are qualified, is an ongoing challenge for Myanmar companies. Getting minority shareholder protections is a challenge. I'll talk about that more in a minute. Conflicts of interest related party transactions, because a lot of companies we invest in are groups, which are good generally, but there can be conflicts of interest, of course. So how do we manage those issues? And then transparency has been a challenge, and needless to say, going from a closed economy to a more open one, there's been legacy issues about transparency that we often have to contend with. So let me give you some real examples of this. A family owning, these are not just in Myanmar, by the way, these are from the region, but I think a lot of these relate to Myanmar. A family owning 30% of a group, comprised of several listed subsidiaries, appointed family members as the chairman and CEOs in all the subsidiaries, right? So they only own 30% of the group, but they essentially control decisions at the group level, and from that we're able to fill the seats in all the subsidiaries through. So they had disproportionate economic rights to control rights that were there. So that's something that we came across, had to deal with. State control for a state-owned entity that we were dealing with. This client wanted to issue a resolution, a shareholder resolution, to fully codify the role that the party committee or the state authorities including final say on most strategic decisions, right? And so it was sort of undermining some of the things that the board should be doing. And so that's a common issue in SOEs that we come across. A conflict of interest regulatory transaction issue. So a family-owned energy company was receiving services from affiliated companies and being charged ad hoc fees that were unapproved by the board. This is not a Myanmar company, by the way. But again, shared services in a group are good. It's a competitive advantage, but not when it's done informally and with sort of ad hoc chargeback mechanisms. So that's something we tried to formalize. The last one here, the chairman and controlling shareholders set up a special board committee, which gave him the power to approve major decisions between board meetings. This actually, he was trying to push this through and we rejected it because it was, again, undermining the role of the board by doing that. So these are real issues. I deal with these every day that come up. So you see governance is a very real issue for us. Let me just maybe stop and see if there's any quick questions, and I'll get into the shareholder rights section. I know, Terry, were any questions that came up, or should I keep going?
Please keep going for now, Chris. There are some questions, but they were related to the SCCM, so we'll take that separately.
Okay.
U and we will get back to you. Thank you.
Okay, I'll go through the shareholders, pause if any questions, then we'll do the board piece, and then we can pause for questions. I have some other examples I want to show you too. Good. Okay, so let me start with shareholder rights. Again, you know, we are, well, let me just do the example. This is very real to us. So you are, pretend like you're a 20% shareholder in Alpha Infrastructure Company. This is a fake company, of course. The controlling shareholder, Bravo Investors, they own 80%, right? So you have 20, Bravo has 80. Bravo owns several other companies that do business with Alpha, right? So you're investing in a group, right? And there's other affiliated companies, very common scenario. So just think, I mean, as a minority shareholder, a 20% shareholder, what concerns would you have regarding these sorts of issues, right? We, you know, when we invest, we are never more than 20%, according to our own articles at IFC. So we're always, by definition, a minority investor, right? And so the issue about minority shareholder protection, which is a key part of any governance framework, is always a crucial aspect. Why is that important? It's mainly important because this is how you attract investors. You know, if you're going to bring in minority shareholders that are beholden to a controlling shareholder who can otherwise make all the decisions pretty much, then a lot of people won't invest, right? They need assurance that the company is going to be run, that they're going to have a voice in certain things about the company. This is why when you look at governance frameworks, OECD on down, the issue about minority shareholder protections is always so crucial. And for us as an investor, as always a minority, we pay a lot of attention to this. So, I mean, yeah, you just think about it. If, you know, you're a 20% investor, and I always say, think of it if it's your own money. This is the way I like to think about these governance issues. It's like you're investing your own retirement in a company. What concerns would you have in those examples? Strategic decisions being taken by the company, you could, you know, maybe have no say in what the company does if you only have 20%. Related to that is the composition of the board. Without any shareholder rights, the majority shareholder can decide the full board of directors, right? They always can vote at the AGM on who they want otherwise. That relates to the oversight of management and therefore the oversight of your money that's being spent. Potential conflicts of interest in the group, right? This is a group, so there's going to be some intra-group transactions for sure, which is fine, but these are, you know, conflicts of interest that need to be managed appropriately. So how are those going to be done? And even potential change in shareholding structure, right? If all of a sudden the 80% owner, Bravo, decides they want to sell their 80% to some other majority shareholder that you don't align with, you don't see eye to eye with, you know, can you get out as well? Can you sell your shares with them? Or if the 80% shareholder wants to issue more shares, it could dilute your ownership. if you don't have certain protections in place. This was the whole Facebook issue when it was founded, about how one of the original founders was instantly diluted because there weren't any sort of preemptive rights. So this is why you can see minority shareholder protections are so crucial for a governance framework, and for you companies that are looking to bring in minority investors potentially now or in the future. This is what they're going to be concerned about, these kinds of issues. So what do we like to see in place then to help mitigate some of this? We want to see shareholder rights that are formalized with adequate protective measures for minorities. And I'll show you some examples of this in just a moment. Minorities have particular rights for certain shareholding changes, like tag-along rights or preemptive rights. I'll explain that. We want to make sure the AGM, the shareholder meeting, is well organized and functions effectively, which seems kind of obvious, but if you're coming into a family company and maybe you're the first outside investor in that company, which we come across a lot, their shareholder meetings probably have not been very formal. It's probably been a dinner table discussion because it's 100% family owned. It changes now when they bring in shareholders. There's you know, you need to get in line with your company law that came into place last year. There's certain protocols there, and then as minority shareholders are going to have certain expectations about how those meetings are run and how their opinions can be voiced as well. Procedures for nominating, electing directors, information shared to shareholders, policies on conflicts of interest, and then also just the views and interests of stakeholders. This is more broadly about environment and social issues, that the company is committed to these things. So when these are sort of shareholder practices we want to make sure are in place when we're investing in companies. Here's some examples of specific protections. It's not exhaustive list. You know, and these are things that we will routinely ask for when we invest. So a right to nominate a board director. We want to sit on the board. We maybe want to see supermajority thresholds for reserve matters. What do I mean by that? So if there are major decisions about the company, we want to make sure that controlling shareholder gets input or gives a voice to the other minority shareholders, right? So we might say that there are certain types of decisions that require either 66% or 75% shareholder approval. So you have to get the approval of one or even all of the minorities to pass certain reserved matters. Consent rights, you know, it's pretty standard for us that we will say we have to approve certain major decisions about the company, like issuing new shares, for example, or other major things, liquidations, etc. And most minority investors will do the same thing. It's pretty common. Long rights for change of control. So again, if you're, you know, if the 80% shareholders wants to sell their shares to someone else, this is saying you need to offer our shares as part of that deal because we want to be able to exit as well. Preemptive rights for new shares. If you're going to buy new shares, give us a right to buy new shares to keep our percentage ownership at the same level if we choose to. And then information rights. We want access to certain information about the company on a routine basis so we can stay informed, just like the majority shareholder would. And policy rights. You know, this will differ by shareholder, but for us, this is important to say there are certain types of practices, say environment and social practices, that you need to abide by and you need to adopt formally. Okay, so again, here's a real example from one of our agreements. I won't go through it in detail, but just to highlight again, we have a section on corporate governance, and that's where we will specify, depending on the company and the situation, we might say that we want the board to be set up in a certain way, right? In this case, you know, we want to have at least 3 independent directors for this particular company. This is a real company that we're pulling from. The second paragraph says we also want to make sure there's an audit committee with all non-executive directors and at least an independent person chairing the committee, and you know, other sort of provisions that we might include. So we address this head on in our agreements. We also will have other procedural things about how the board meeting needs to be run formally according to certain procedures. Shareholder meetings need to be run formally according to certain procedures. So we're very, we're quite strict about this. Likewise, as I said, we'll have consent rights quite often. This is just standard, a standard list, but again, it will say, we as a shareholder want to have a say on certain major decisions about the company, things like you see here, right? Creating, authorizing new equity securities, changing the nature of the business, of course, make disposals of assets above a certain amount. These kinds of things, we as a minority need to approve that before it can be done, even if we just have 20%. That's part of the bargain. Otherwise, the majority can just do anything that they want to do. Other examples here, we don't need to go through all this, but just to give you a feel. Yeah, okay. Let me, we're still on the shareholders part. Let me talk about conflicts and related party transactions. This is a very common issue that we see in Myanmar, but even the wider region. So again, I'm going to give you some real examples to bring this to life. ABC company, 60% owned by Chairman Max. ABC company is now planning to purchase XYZ company, which is 100% owned by the brother of Chairman Max. Okay, that's going to raise some eyebrows, but would you be okay with that? If you're on the board of ABC company, would you be okay with that? I mean, it might be okay. It might make sense, but you'd ask, first of all, who authorized this? Yes, the chairman himself cannot make this kind of decision normally. What price did we pay? Is it a fair price? This is a related party transaction. And why are we doing this strategically, right? So it needs more vetting to make sure, but that should raise some eyebrows. Fortune company is 70% owned by ABC Holding Company Group. Fortune companies buying construction services for a new port facility from Techie Company, which is part of the same group, right? So there's services being provided from affiliated companies. Very common situation, can be perfectly fine, but this is related party transactions. These companies are related, they're affiliated companies. So are they done at arm's length? What's the price that we're being charged for these services? Are they, is it the right company to do them? These are the things that we want to see addressed. The concern with related party transactions, obviously, is that money can be leaked, right? From one company to another one, or from one company to an individual, if they're not governed appropriately. Maybe they're overcharged for services. Or in this case, here's company, Alpha Company is planning to sell real estate to its affiliated company, Bravo, for a substantial discount. Alpha and Bravo are part of the same group, but have different minority shareholders. So we see this a lot too, where if a group is maybe consolidating different assets, maybe up to the group level where we're investing, or to some other corporate level, and they have to buy and sell assets to do that, land or property, what's the price being paid? Are you overpaying for something, which might give benefit to other parts of the group, not the part you're investing in? Right, so real estate transactions very much are, this is a common issue, and these are related party transactions. Okay, so, we want to see this governed properly. Groups, again, this is a competitive advantage for groups. Related party transactions, they're fine, but we want to make sure they're governed appropriately, because again, as a minority, we could be taken advantage of. So these are just some guidelines. The IAS 24 has some guidance on reporting on related party transactions, how they're defined, et cetera, which is very helpful. But we want to make sure that the review and approval process is set up so that you have, there's no collusion. You have people that use themselves if they're conflicted, try to make them arm's length and do the market test as much as practical. I like to see any sort of related party transaction that's above a certain threshold, either run them through a separate committee that's set up for related party transactions, which is common for banks. I know in the Philippines, for example, they require all banks to have a separate related party lending committee because it was such a problem there for so long. If you don't have that, then through the audit committee, because the audit committee, we want to make that as independent as we can. And therefore, if you can run these through the audit committee and get their blessing, then that's a nice control to have. And we will commonly require that to be in place. Okay. Let me stop and see if there's a question or two before I get into the board piece. I'm conscious of time, but.
Yes, hi, Chris. We have 2 questions on minority shareholder protection. One is on the voting system. The question is, what kind of voting system, cumulative voting or statutory voting, is more suitable for minority shareholders?
Okay, it depends, I guess, like every situation. So cumulative voting, just to explain what that is, for those who may not be familiar, sorry. Let's say you have, you're at your shareholder meeting, you're electing new board members, right? Let's say you have new board slots that you have to elect in that meeting. Cumulative voting gives extra power to minority shareholders that says basically you can take your votes for each of the 3 that you could vote on for those 3 positions, and you could combine them to vote on certain candidates to give you more power essentially for voting. That's a form of minority shareholder protection, which is good in a lot of cases. So it really depends. For us, we don't usually require that because, again, the nature of our investments they're closely held companies where it's typical that there's maybe a handful of shareholders or less in the companies that we're investing in. It's not thousands of shareholders that we're investing. We invest in private companies, not publicly traded ones. A lot of the private companies we invest in will list eventually and go public. So we are in a lot of public companies because of that, but they're usually closely held companies. So cumulative voting doesn't really make sense. Instead, in our context, again, it's more about the board nomination rights are negotiated up front to say, you as a shareholder, other shareholders at 10% above will have a board seat, can nominate someone to the board, or have a say in other shareholder matters. So it kind of depends on the situation. Was there any other question before I continue?
Yes, just one more on minority shareholder protection. So do shareholder agreements, like we discussed, need to be reflected in amendments to the company's memorandum of association or constitution?
Yes. Yeah, in fact, our shareholder agreements say that. They'll say that upon execution, the company needs to incorporate these into the articles of the company as applicable. Yes, they should be.
Great. Thank you very much. I think that's it for now, and we can move on.
Okay, somehow I stopped sharing. 1 second. Okay, so we'll get into the board, and again, the board level, right? The board of directors is the heart of good governance, of course. And so we spend a lot of time looking at this. And how do we break down a board? If someone asked you, how effective is your board at your company? How would you answer that? Again, it's kind of a vague question to answer sometimes. And this is how we break it down. Is we look, first of all, the roles of the board and the director duties. So what role is the board playing, right? That seems very straightforward, but you'd be surprised. A lot of companies we have where they're meeting maybe once or twice a year. Really, they're just set up on paper. There's a company I'm dealing with right now, not in Myanmar, but it's a Chinese company, where they have a 1-person board, but they have a separate management committee that really functions like the board, but it's not really a board, right? So legally they set up a board, but then it doesn't function. So it's things like that we want to start with, to say, do you have a board, and what is it doing, right? And is it doing the things that we'd like to see them doing? Director duties as well. Who are the directors, and they understand their duties as directors? I'll talk about that in just a minute. Board structure and composition. So composition is always the most interesting question about governance, about who's on the board of directors and are they the right people? What skill sets do they have collectively? Are they independent, objective? Who are they representing? That's always one of the key things that we look at, and we will commonly, we won't say specific people have to get off the board, but we will commonly ask for structural changes over time if we think it's appropriate. And then functions and behaviors, right? This is, so what's the behavior of the board? How well does it actually function? So it may look good on paper, but how are decisions being made? How does it function at board meetings? All of these best practices, so to speak, are really trying to affect a behavior in companies, starting at the board of directors level, right? So you can have the best practices on paper, but it doesn't behave or function well. And I have an example or two that I'll show you. So that's the bottom line, in my view, on is the board behaving and functioning the way you'd like to function in terms of providing stewardship and oversight to the company. Common challenges that we see, the board acts as sort of a paper board, like I said, the one that set up legally but doesn't really function. Composed of insiders, right? So there's really no independent members or other external type people, maybe all family members, for example. There's a lack of financial and risk literacy on the board, right? Maybe people have business connections, but there's no financial auditing sort of expertise commonly. For SOEs, the politics on the board is a common issue that we come across, dominated by one or two individuals, right? So again, if you have a controlled company, which is typically the case, it's quite frequent that you have the majority shareholder who's also the chairperson of the board, who's also the CEO. Very common situation. That can be fine, by the way, but you need to make sure that that person isn't dominating all the discussions at the different levels, particularly in the boardroom. So that's a common issue that we come across. And informal working procedures, uninformed board from the management, committees that aren't working effectively, and then no clear division between the board and management. Again, this is a common issue because of the controlled nature of companies that we see in Myanmar and in the region. So let me give you some examples of this. The chairman of the board of ABC Company requires the CFO to send him all checks to be signed off, and he also must sign off on all new hire positions. Right. These are all real examples from our investment activity. This was an airline, not in Myanmar, but in another country. This was actually happening where two brothers owned this company, and they were controlling every single little decision like this. And the senior executive team was actually complaining. It was a really strong team, but they had no power. And so we had to talk to them about fundamental governance changes, before we went forward. This bank board meets monthly for approximately 2 hours, primarily focusing on ratifying credit decisions made by management. So this is all they would do. It was actually a really good board. They had a lot of expertise on the board. They had a lot of independent members. This was not in Myanmar either, but on paper they looked fabulous. But again, you saw what they were doing, and all they would do is approve these credit decisions, and they didn't even know what they were approving. They would get these loan documents, 500 pages in total. They were expected to read through and then approve certain loans, and they didn't really know what they were approving. So, that's all they were focusing on during board meetings. So that was a big issue we had to try to address. The audit committee of this company met 40 times during the year to increase focus on internal audit issues. So you had a board level audit committee meeting 40 times during the year. That's almost weekly, which is, that's way too much for a board level committee to be involved. So, we look at the board and the role that it's playing. What is it doing? And this blurring of lines between the board and management is a common issue. And it's difficult because you want a board that's engaged, A lot of times we see boards that are totally disengaged and have no idea what's going on, but you don't want them micromanaging the management team either, right? So it's kind of the nose in but hands out approach. Remember, you as a shareholder, we as shareholder, relying on the board to oversee the company on our behalf. You know, how is our money being used? And so if they are really managing the company, then the oversight function is compromised. So it's a fine line on how you define, you know, what the board is doing and what management's doing. This is just an example from a client. You know, these are the sort of things we like to see the board doing. It's not just focusing on the financials every quarter or credit decisions. It's things like, you know, strategy first and foremost. That's one of the key functions of the board, is setting the long-term strategy. Risk is part of that, monitoring performance, the senior management appointments, CEO appointment, you know, there's a whole, the overseeing audit and control matters. It goes on. So there's a lot of things the board should be doing throughout the course of a year. And so we want to make sure that it understands the role that it's playing and that the agenda of the board reflects that accordingly. Let me talk about the chairman's role quickly. So again, in controlled companies, this is a common issue where you have a all-powerful chairperson, like this situation for ABC Company. So 70 shareholder of ABC Company, and he also serves as chairman of the board. He founded the company and made it very successful today. Very good. He uses the board mainly to provide advice on certain matters, but then makes major decisions and communicates those to his management team on a daily basis. He feels that the company will perform best if he maintains control over key strategic decisions. As the major shareholder, he is entitled to do so. That's what he feels. This is a very common situation. What's the problem with that? Again, you have, first of all, the chairman owns 70%, not 100%. So there are other minority investors. He's not using the board like it should be used, that can really add value in terms of bringing different perspectives on strategic decisions or on oversight. And he's making a common mistake, which is, you know, some chair people, men or women, think that they're the ultimate decision maker, especially if they're the controlling shareholder. That's not the case. That's not the role of the chairman. They're supposed to be overseeing the functioning of the board to provide stewardship and oversight of the company. So that's a difficult one to handle a lot of times. But it's very common. Director duties, let me touch on these quickly. And I think we're getting near the end, but I have another couple of examples, but I think this is important as well. Director duties, when interviewing a senior board member for this bank, he indicated that his primary interest as a director is to obtain favorable terms on loans for his other businesses. He is one of the bank's biggest customers. This is a real client, believe it or not. Again, this is not in Myanmar, so it's self-interest. He doesn't realize that's not why he's a director on the board. He's supposed to be looking after the company as a whole, not his own benefit, his other companies. Unbelievable. A board member represented a 30% shareholder in this company and indicated that his primary duty as a board member was to look after his investment. So again, you know, you are there to represent and to look after the company and the interest of the company and all the shareholders in aggregate, not just your own self-interest. Usually they're going to be the same, but there could be cases where it's different. If this 30% shareholder was looking to sell their shares in the near term, that might affect the behavior of that director in terms of the decisions they would make that may not be in the best interest of the company as a whole. Right? So there could be a misalignment of interest in certain situations. A board member was appointed to the board by her family, which holds a controlling interest of this company. She attends meetings once per year, but often votes according to her father's instructions. So it's, you know, she's not a productive board member in this case, just doing what her father said. You're there to serve a purpose, to uphold certain director duties. Your company law is a good law that's come into effect, right? Drafted in 2017, and now it's been implemented, I think, last year, right? It has very clear director duties in there, which speak to, among other things, the duty of loyalty and the duty of care. These are really a good achievement to have these embedded in your company law, consistent with international corporate law, which basically says, directors should be loyal to the company, not looking after their own self-interest. You're looking after the shareholders in general's interest, and you have a duty of care to show up to meetings, to vote, to educate yourself, to participate, etc. Your company law has this explicitly in it, among other director duties. So yeah, it's already there. When we appoint directors to companies that we hold equity in, we tell them the same thing. You're nominated by IFC, but you're looking after the interest of the company as a whole. So you vote how you think you should vote. We don't tell them exactly how to vote on specific issues as board members. We leave it to their judgment to do it. Okay, so board composition, what we look for as an investor coming in, things you can consider: a balance, right? The type of directors, executive, non-executive, independent, good mix of experience, subject matter expertise. The more balanced and the more diverse set of perspectives, generally speaking, the better the board's going to function, and therefore the better decision making you're going to have. A couple other quick examples. I'm conscious of time, but I think we're okay. These are other real companies that we've invested in. If you just look quickly, so this is a bank, and this was the current breakdown of the bank's board. And I think if you just focus on the family friend column, the background column, you can see that basically a large percentage of the board members were either family members or friends of the family. And only, 3 of them had banking backgrounds, right? They don't all have to have banking backgrounds, but 3 out of 11, you're not doing so well there. So that's a good example of a company that was family dominated. They only own 58% of the bank, or did at the time. So that's one example of a board that need to look at their composition. Here's another example where this is a listed company in a neighboring country which has a very strong listing regime, let's just say. On paper, they look fabulous. 5 out of the 10 directors are independent. They have audit committee that's entirely independent. That's music to my ears. But yet the board didn't function. When you start to talk to them, and the CEO in particular, it didn't really function. It was sort of a perfunctory board. They would meet quarterly and just approve whatever the CEO put in front of them. And the CEO himself said, I need help. I want a board that can help bring more value to me. So even though they look good on paper, they didn't function very well. I highlight the age column. It's not because of age necessarily, but the point is that it needed more balance in terms of diversity, age, and otherwise, to bring in different and be more active in helping the CEO guide the company. One last board composition example. This is a family company. You had the family that had 60%, and then 2 other outside investors that had 20-20. So 60-20-20. And so you had the family members. You had the chairman and CEO who are brothers, and then the vice chairman is the brother-in-law, and then you had 2 of the wives sitting on the board as well. But the wives that complain that they're not being heard, they're ignored at the board meetings. Basically, the brothers were using them just to fill seats so they'd have a majority board representation, which is not healthy. And then the other 2 investors, Investor A and the National Bank, they would rotate people to attend board meetings. They each had 2 positions, but they never sent 2 people. So it was a really unhealthy mix. We worked with them to revise the composition there. Okay, I just want to give you some real examples to bring. These are things we deal with every day. Independent directors, why are they important? Really, they bring in, it's not just that they're independent-minded and objective. Remember, all directors really should be objective-minded. That's, according to director duties. But independent directors can help bring in that added objectivity, but also bring in, more importantly, in my opinion, certain skill sets that might be lacking. So when we invest in a company, we look at the board, who's on the board, what are their backgrounds and skill sets, and we will quite often, ask them to maybe bring in additional people with specific skill sets, and we will identify those skill sets. Maybe they're getting into a new industry, and they need those skill sets, or a new market that they're lacking that expertise. So we will prioritize skill sets for them to bring in over time, and that we appoint. When we appoint someone, we commonly look for people with specific skills to fill that gap. Okay, I think in the interest of time, let me fast forward a bit, because I do want to leave some more time for questions. I've been going for about an hour, I think. Let me just close with one other case here. This was this is a Vietnamese company, and they you can see the situation before they went through some governance changes. They had a board which was 5 members, as you see here. Really, though, it was a board of 2 people. It was the chairman/CEO, who the chairman controlled the company, and there was one other outside investor, private equity, that had, I think, 20 to 30%, and those 2 really made all the decisions, and the rest of the board really didn't participate. And everyone reported unilaterally to the chairman CEO. All the different departments, even internal audit went up through the chairman CEO. So you can see the bottleneck it created in this structure. Long story short, they went through a lot of changes and moved to this structure, where it's a more balanced board. They brought in different outside directors with specific skill sets. They were getting into hoteling, from travel to hoteling, which is a completely different animal, and they lacked that expertise, among other things. And then set up proper board committees. We formalized decision-making between management and the board, and a lot of other things that they put in place. And so, yeah, this just summarizes the changes they made. I won't go through this in detail, but again, we went through what I just showed you, the methodology at the different levels, and said, here are things that you can work on, put in place, and they've done that. And then they've talked about the benefits of making those changes over time, right? Better access to capital, profitability, reputation, efficiency. So we have lots of examples like this where we've done this, and just to kind of bring home the power of some of these changes. I think I'll close with just saying, do visit our website, ifc.org/corporate governance or /sustainability. You can get to it either way. And you'll find the methodology there. You'll see lots of publications as well, interviews with some different, investors, these kinds of things. So I encourage you to go through this. I would just close by saying that with 2 things. One, governance it's a long-term journey. So some of this may be overwhelming for medium-sized companies. It's not one size fits all. It'll come in different sizes and shapes. It depends on your company. Start slowly. But I think if you start to look at areas you can improve over time, and you're thinking about raising capital or trying to attract business partners, these are things you should start to prepare for now to anticipate those kind of events. And then lastly, I want to thank the Institute. I encourage you all to join the Institute and take part in their different programs. There really is a lot of different good offerings. And I think they're going to try to continue to bring more subjects to the market as much as they can. So a big thanks to all of you. So I'm here for questions, Terry.
Chris, thank you so much. It's a fantastic presentation. We've already had a few requests to get the material, which we will get to you on the MIOD website. And as Chris mentioned, the IFC website also has a whole wealth of information on this. There are a number of questions that did come up on the board effectiveness section. I have a few myself. And just to everyone, just a reminder that you can ask questions in either Myanmar or English in our chat box, and I will get that fed through to Chris. Chris, let's start with a few on board effectiveness. There's one on family-owned businesses. And the question is, as you mentioned, most family-owned businesses in Myanmar have boards comprised of mainly family members. Other than the situation where a minority shareholder comes in, at what point in the development of the company do you think it makes sense for family-owned companies to establish a board with independent non-executive directors?
Yeah, that's a great question, and we come across this a lot. So, I always say it depends, but let's say it's a family company that's 100% owned, and like you said, there's no outside investors coming in the near future. There's still benefit to be had from having a properly functioning board. What does a board do? It provides stewardship and oversight of the company generally, right? So, you can benefit by maybe considering bringing in other forms of expertise, other perspectives to the decision-making process that the board undertakes, right? So that could be a potential benefit, just having those outside perspectives or different subject expertise into decision-making. And or, it could strengthen your oversight role too. Right? If you're a family company, oftentimes you're sitting at the board. If there even is a functioning board, a lot of times there's no really formal board, but you're also typically running the company day to day. And, so sometimes you need an extra set of eyes to help make sure you're controlling the business adequately or looking at it in a different way. So those are potential benefits that any board can bring. What I do say, though, for family companies is, ease into it, because you might be reluctant just to bring in someone that you don't know. I wouldn't suggest that in case they don't work out. One thing we often tell family companies is maybe start with an advisory board, right? Where you can have an advisory board of, 3 to 5 people, let's say, certain expertise. Maybe you're expanding your business into China or something, or a different product line. You need expertise to do that. Form an advisory board, which does not have the same legal implications by far. And they can kind of function as a board, and then you have the benefit of, if they work out and you want to make them full-time board members, you can ratify them as board directors eventually. Or you could, if you don't find the value, you can always just discontinue that board. And it's much easier. They're like consultants essentially. So that's kind of a typical path we might suggest, but it always depends.
Great, thank you. Sorry, I had a bit of an audio issue. Another question on board effectiveness and board function. I'm going to read it out, and this is something that I wanted to ask as well, but let me read the question out itself first. In a dominant shareholder scenario with strong influence over the board composition decisions, there could be a challenge to maintain and implement governance best practice. As a management team, there can be a challenge to receive balance and objective directions and decisions. And the behavior from a board of directors can seem disengaged or unilateral based on the dominant shareholder's point of view. Do you, Chris, have a tangible example where you've witnessed this behavior? And what mechanisms would IFC insist upon as minimum requirement to enter into a due diligence process for consideration of investment?
Yes, we've had lots of examples. This is not an easy process. I hope I didn't suggest it was. It's it can always be a challenge. I mean, and we've had lots of cases where, when they're at the point of investment, when they're interested in getting your money, they might have one tune they're singing versus 2 or 3 years down the road, it can be a bit different. More cases than not, it's worked out good because it starts with who is the sponsor. And they usually understand what we're trying to do, because it's not just governance, it's also environment, social issues, for example, and other things. And they come to us for that reason. They want to benefit from that. And they see it'll help their reputation, help competitive advantage. So we have more good examples, way more good examples than some challenging examples, but certainly they exist. I think it's, there's full observations. One is that's partly why we bake it into our legal agreements in a lot of cases, in most cases. But I hate to use that punitive sort of approach, right? But the other way is just, again, setting up the proper board of directors. That's not just all family members. Let's say if it's a family company, or state-owned enterprises too can be a challenge. That's even a bigger challenge, frankly. But making sure you have a balanced board of directors that can see through some of these changes, give ownership of governance changes or environment and social on that side of the equation, give board visibility to those issues, and make sure that they see it through. Give one of the committees the power to see through the implementation plan. And we'll often have our nominee and or an independent be on that committee to help keep pushing for those changes. So I know there's a bank in the region that we dealt with, and that was the case, where we were struggling a bit to get through some of these changes. And we finally got through, but it took a long time. But it does come down to, if it's a controlled company, I would say there's good and bad with that. One is the good thing is that if an individual wants to change something, it can happen quickly. The controlling shareholder, who's often usually the chairperson. On the other hand, if they don't, then you've got an uphill battle to convince them to follow through on certain changes. Yeah, but it's a challenge a lot of cases, yes.
Great, thanks, Chris. So you mentioned that you nominate a board director, and there's obviously a strong push to have qualified independent directors. This is a question from me, which is, after sitting on a number of boards, what I find is that as a board member, sometimes you see the dysfunction, but you may be numbered. You may have an enlightened owner who brings things along, or even if they want to change, they might not know how to impact the board to become more effective and really receive that diversity of opinions and wisdom and governance from the board. What suggestions do you have based on your experience for board members struggling in that position, where you may be, there was a term that was used to describe a different situation, but swimming through treacle, where you feel a little bit helpless at times?
Well, send them to the MIOD Director Certification Program. Send the whole board there, and then maybe that'll help get some like-minded directors on the board. No, but I think again, it can be difficult if you're the lone voice in a boardroom. It's difficult. Yeah, I mean, it's just human nature. But again, that's why it starts with getting the right board balance, and it's not just about having one independent, for example, but if you have a good balanced board with maybe minority shareholder reps there, one or two independents, whatever the case may be, even if the controlling shareholder still has a majority on the board, which they have the right to do that, I think you can still have an influence. If you have enough voices on a certain matter, you can have an influence on decisions over time. Not always, but you can do it. I think also it's just about if you can bring along those other board members to see the value and the benefit of doing something for the company, then maybe you can start to change the hearts and minds over time of some of the more difficult board members. But it's a struggle. It can be a struggle.
A bit of a follow-on to that, how do you measure board function? How do you evaluate it? Because it can be, as you mentioned earlier, a board can look perfect on paper, and down to also, having the right documentation. If you go in, and if somebody like the MIOD would go in and not really understanding how the boardroom functions, but looking at the board members, the documents that come out, are they complying with all the constitution? They could look fantastic, but actually not function. And the company is probably not getting the benefit of that board. How do you actually measure actual effectiveness of a board?
Yeah, that's a great question. But that's when I showed you the board breakdown before. I mentioned the last bucket was sort of the functions and behaviors, which is intangible, but it's the most critical. When we first assess a board, that's why I want to talk to board members individually. So I will interview board members by themselves. I don't want to do it as a group because they're more reluctant sometimes to speak out. And I will tell you that in most cases, people are really open and honest. And a lot of cases, they're almost relieved that they have a sort of a vehicle to voice their concerns about things. I mean, I remember there's a company we work with in the region that had a really strong chairperson that owned the company. It was a well-known family company in that market. This is not in Myanmar again, okay, but but the board of directors it was a great board. Again, they had a lot of these experienced people, like, ex-central bank person and really senior accomplished people on the board, but it didn't function well at all. And because of this, because the way the chairperson ran the meeting did not invite opinion on matters, had a very strict agenda, very focused. And it wasn't until we start to interview the individual board members, it was almost like a therapy session, where they were saying, thank you for this opportunity. And then we got a lot of different insight from that. So I think so it's through that process, but on an ongoing basis, that's why we also say boards should put in place an evaluation process. And you can keep it anonymous, but that gives them a vehicle to also voice these kinds of concerns that otherwise you would never get to. So that's kind of how we approach it.
Thank you, Chris. I think our board secretary, Krista, also said that both qualitative and quantitative measurements are important for evaluation. So thank you for that. Before I move on, I'd like to also thank Dr. St. Joy, who's the director of the Security Exchange Commission, who responded to the previous question from Uwin 9, where this is a question for private placements. So the security exchange laws and rules have no provision for private companies. If a private company wants to do private placement, it can be done under the Myanmar Companies Law. So hope that is helpful. Just carrying on the questions on directors, there's somebody from the from a microfinance industry asking, what are the opportunities in Myanmar to find the correct independent directors, industry experts as we grow along?
Well, the MIOD hopefully eventually. Well, again, that was one of the reasons for to get certified directors that companies in Myanmar can choose from, because this came from our own experience. We invested in some companies, and when we want to have them bring in an independent director, they'd have to pay so much to bring in some foreign director from another market, and also just it didn't work. You didn't have the knowledge of the local market that was required for that company. So this is a big opportunity, and there's plenty of potentially qualified directors, obviously, in Myanmar, and there's a big need for them, for these companies. So I would, MIOD, it's still getting going, right? It's doing fantastic, but we're building up a bigger pipeline every year. Look there, but otherwise for MFIs, I know we do a lot of MFIs. It's a bit different skill set. It's not like a typical bank, obviously. So there it can be, I think, just through a network. I mean, we will reach, like if we're investing, we have our own database. We'll reach out to people that we know are MFI experts and try to bring them in. So yeah, I think just through those kind of networks otherwise. But start with the MIOD.
Thank you, Chris, for the plug. And indeed, one of the main objectives of the MIOD is to take people who are very qualified, who are already in Myanmar, to give them the skills that are needed to become board members. As I was mentioning in my introduction, I didn't quite appreciate how useful that was and how valuable that was for me as an individual until I actually went through an IOD training, and I thought that I had the right experiences and skills, and I was already sitting on boards, but only when I had the training that I understood the very big responsibility that you have being on the board of directors, but also what I was given was this toolkit and the ability to assess, so that hopefully all of you here who are already board directors who some of you I know have already been through IoD trainings and with the MIOD as well. So you will hopefully be able to back it up, back up what I'm saying. But also those of you who haven't had a chance to encourage your board members to come to training. And also for yourselves as well, if you're board directors already or want to be board directors, to come and learn. So thank you, Chris, for that. And it is indeed one of the main reasons why we exist. So just questions, again, we do have quite a few coming in. One question, Chris, is how do you enforce, for ESG, how do you enforce the E and S or as a minority shareholder?
Well, I'm not, I'm reluctant to talk too much about E and S because I'm on the CG side and I'm focusing on that. But again, it's the same, it's even I'd say even a stricter approach where it usually is part of our investment agreements. It is, in fact, almost always part of our investment agreements. And we have a much more active follow-up mechanism for those issues. There's challenges that can exist, of course, as you would imagine, but it's really through that portfolio function that we try to follow up on what the companies have committed to, generally speaking.
Great, thank you. And with ENS, I think we can follow up separately. Dr. Yang, if you want, please drop us a line. On another question is any recommendations for a company when dealing with government departments to keep good corporate governance practices without losing business opportunities?
Wait, I missed the last part. So, sorry, say it again. I kind of misunderstood the last part of that.
So I think it may be alluding to the fact that while, and this, if I'm understanding the question correctly, and this comes from Dr. Zawin, who is also one of our trainers who's gone through directors training and also runs a company here that might approach government tenders. So if I'm not understanding correctly, Matuza, please do jump in. So this is specifically for people dealing with government departments. You want good corporate governance in place, but when you are implementing CG, you may lose business opportunities. And maybe Matuza, I don't know if you can unmute yourself in our system. If I didn't paraphrase you correctly, please jump in. It doesn't look like you can unmute. Maybe you can just type it.
The only thing I can imagine, maybe what the question is getting at is, if you have, maybe some companies are reluctant to go to a higher standard that you're looking for in terms of governance or environment and social, or the case may be, and therefore, you might lose some investment opportunities. I'm not sure if that's what the question was about, but that we do see that sometimes. But our response is that's, we don't lower our standards because of that. It shouldn't. I think we see the benefit of this long term. There's a strong business case to back it. So I think that's the position that we take.
Okay. There's a question, but that might not be directly related, but I'm going to ask it anyway because, and if you don't think, Chris, that it's related to this, we can take it offline. In a public company, is the term of a chairman unlimited as long as he gets the majority votes from shareholders at the AGM? Can it be limited, for example, maximum 5 years for chairmanship of the board? Maybe we can talk about best practice versus rules and regulation. I believe there was no limit on rules as far as the law is concerned.
Yeah, I don't think your company law has a restriction on that. And for private company, if we're talking about a private company, usually there's not much that would govern that kind of thing, right? It's really up to the company to decide that, and the shareholders in particular. And so some jurisdictions, like for public companies, will have limits. They certainly have limits on independent directors. Usually 9 years or more, they're not independent anymore, some even less. But for just a routine director that's not classified as independent, some even have caps on the term that they can spend as a director on a board, right? But usually we don't see that. It's more about can they still commit to the company in the same way in terms of time and value add and everything like that. For the chairman role in particular, again, it depends, because a lot of the companies we are with, it's a controlled company. So the majority shareholder is going to want to appoint the chairman, as long as they're private, and that can be fine as long as we think the rest of the board is balanced appropriately and there's enough of a voice in the room to make sure that the chairman's not dominating every decision. That can be fine. If it's a public company, again, like in Singapore, for example, if you list in Singapore, they want you to have an independent chairperson. They want you to have an independent chairperson and separate from the CEO to list, right? You don't have to, but if you don't, then you have to have more independent directors in total. So they're very strict about that for listed companies, but that's a different situation than, say, an average private company.
Issue of the chairman. The question is, since the chairperson is quite a crucial role and can have a deciding vote when there are ties in the board meeting, does IFC try to have a say while appointing a chairperson?
I mean, it's usually part of the whole negotiation when you're, again, because we are dealing with a shareholding structure that's usually a handful of shareholders or less. It's not dozens and dozens of shareholders usually. Then all this kind of stuff is usually negotiated, where we would say about the board composition generally how we would like to see it, the ratio of independence, the types of skills. And then, but the chairperson, usually the sponsor will want to take that position, and we're generally okay with it as long as there's not some really outrageous reason not to be. But the whole thing, I would say, is part of a broader negotiation up front about how that should, what that should look like.
Great. I'm just going to read out something that has actually been answered on the chat, just for the benefit of everybody. There was a question on currently in Myanmar, must all companies have independent directors? And another same person asked, are corporate governance rules already launched to be complied for all private companies to comply with? And thank you, Vicky, for answering. Ms. Vicky Bowman, Director of the Myanmar Center for Responsible Business, who is also a board member of the Myanmar Institute of Directors, has answered that the only requirement in the Myanmar law for independent non-executive directors are for banks. And that comes from the Central Bank of Myanmar's directive, and for the listed companies on the Yangon Stock Exchange, and that is an SECM directive. And the Myanmar legal requirements, quite a lot of them are summarized in the Puntesa report, which can be found on the website of the Myanmar Center for Responsible Business. Anna, thank you. Anna Leah from IFC is also answering and saying both SECM and DICA are currently contemplating adopting a corporate governance notification, which will require all listed companies and non-listed large public companies, so it doesn't matter whether you're on the Yangon Stock Exchange or not, to appoint at least one independent director. This is a draft regulation at the moment and is being reviewed by the relevant authorities. So we believe that it's going to be effective mid to late next year, 2021. Okay, so I think a lot of some of the questions have been covered. One is what kind of performance should be included in the evaluation process for board and senior management, which is a little bit of a twist, I think, to what we've been discussing before. So, Chris, do you have views on that?
The evaluation process, well, they're really different. The board evaluation, we want them to do it once a year, right? And often what we'll say is, year one can be just a self-evaluation. We like to keep it anonymous, but the board completes an evaluation form and then it's summarized and discussed at a board meeting. The second year, maybe every second or third year, it's good to get an outside evaluation done, if that's possible. That's a good practice, but it's not absolute. That's at the board level. But then at the senior management level, of course, this is one of the main board functions, is to make sure you have a robust performance management framework in place for senior management. That should align with their strategic objectives being set by the board, targets being set by the board, how that then drills down into the company, into their, say, a scorecard for the senior management. And it feeds into how they're evaluated and how they're incentivized, their remuneration. That should all tie together in a form, and we look at that. That's just part of internal control. When you look at your internal control framework, it's not just checks and balances on approval, who's approving checks. It's your planning and performance management process is part of your control framework. So we always look to see how formal it is and how, if it needs to be more structured, to provide the right incentives and hold people accountable.
Great. Thank you, Chris. No further questions at the moment, but I do have one while we wait for maybe other questions to come in. This webinar has been the view of the investor on corporate governance when you're investing, to really strengthen the health of the companies that you're investing in as investors. What's the view from the investee companies? I know, at least in Myanmar, we've gone through quite a bit of a journey where when the country first reopened again in 2012, and investments from institutional investors, development investors, such as IFC came in, it was quite a new process for most companies. Even for the large established companies, it was a bit of baptism by fire. The process can be described as painful. But I know that a lot of companies that I know, and I was part of that process earlier as well, felt that that was actually really beneficial, and maybe others didn't. So what kind of feedback have you received from investee companies, both here and in the work that you do around the world?
Well, yeah, that's a great question. I mean, if you go to our website, IFC/corporate governance, we have from around the world case study documents, publications, that it's testimony from the investee companies, and we ask them, what did you change, and then what's been your experience? What have been the benefits? And it's very powerful. It's coming right from the companies. And so we have one for Asia. I don't think we've incorporated some of our Myanmar clients in there yet, but we have a lot of examples in Myanmar, and we're getting the same sort of feedback. But we will bring those in too as time goes on. But in any case, read through those, and you can see a lot of powerful testimony from the actual companies.
Great. Thank you. I think we've covered actually quite a few of the questions that I had along the way, and definitely what's been coming through the chat. So just a last call, if anybody does want to ask questions, we are available as well to follow up with you. And I'm just going to put in our chat the email for MIOD. It's info@myanmariod.com. Any follow-up that you might need, please let us know. Any questions that you have on the Myanmar Institute of Directors, and really anything at all that comes to mind, please get in touch, and we will be publishing the recording of this as well as the slides on to our website, and we will be informing everybody who joined at that time. So we do have one more question. Thank you very much. The question is, has non-willingness to adopt CG standards been a deal breaker ever for IFC in Myanmar while negotiating with probable investees? How many such cases have you faced?
I don't want to talk about specifics in Myanmar, but let me just say this does happen. One of the examples I talked about earlier, the airline, where the two brothers were making all the decisions. There were other things going on. They were bringing money into the company, and no one knew where it came from, the CFO, but all related to governance. And we talked to them about it, and they didn't go along with what we were trying to do, and so we walked away from the deal. We weren't comfortable with how they were going to govern the company. And so we walked away from it. And there's other examples globally we have, as well. But I would say mostly, so let me just end on a positive note. That's kind of a downer. I mean, look, almost every company we deal with has areas for improvement on governance, right? I mean, it's always, that's fine. I think for us, the key is we know that they're committed to making changes, and they agree to make certain changes over time. And so that's by far the most important thing. But I can look at any company, even big listed companies in New York, and find a handful of problems. So it's more about the commitment to making governance changes and environment and social as well. That's the most important to us.
Great, thank you very much. So if there are no further questions, I'd like to just thank Chris so much for this. It's incredibly insightful and helpful and gives very practical examples that we can follow. So as you said in the beginning, CG can be quite a nebulous concept, but really after going through this, I hope everyone listening and joining in will agree that we now have a better sense of what corporate governance means and how it can actually help companies. As MIOD, during this COVID period, we are unable currently to run training because of the gathering restrictions. So we are hoping to planning in fact, to organize a number more of these webinars. We hope to do 2 a month, and we really want to see all of you back. The next one will be on cybersecurity and the importance of looking at cybersecurity to protect your organizations. We will announce all of that through email and also on our website. And as mentioned, we will be having the recording and the slides from this session on our website as well. Please join the MIOD. We are a member organization. We are a not-for-profit quasi-government organization that is supported by the IFC, the UK government, amongst others, and also are very importantly supported by the SCCM, the DICA, UMFCCI also sits on the board, and we are here really as a bridge to ensure that government regulations are understood by all of us as practitioners in the private sector, and that each of us in the private sector are able to govern our companies better. We become constantly better as board members and senior management professionals. So here to help. Any suggestions that you might have on how we as the Myanmar Institute of Directors can help the community at large, please reach out. I will put the email again, is info@myanmariod.com. All of our information is also on the website. So thank you again. Thank you, Chris. Thank you to the entire IFC team for helping, especially Anna and Ms. Hatoy, Ms. Lulu, and the IT team for making sure that all of this ran smoothly, no power outages, which is a big plus for us. So thank you again. Chris, many thanks to you.
Yeah, thank you, Terry, and thanks to the MIOD and for Australia Aid and UK Aid for supporting the initiative. Thank you all very much. Stay safe.
Thank you all. See you in the next webinar.